Hello and welcome to this chapter ratio analysis. So first we will understand all the formula, some theory part also will cover, and then we'll take some of the important questions of this chapter. So are you ready? Yes, sir. Okay, so come to the summary of ratios. First we will revise your ratios. All ratios will revise current ratio, current asset upon current liabilities. And this ratio is the ratio for checking the liquidity of the company. Standard ratio is 2:1, but according to the nature of the business, it can be high or it can be low. Next liquidity ratio is quick ratio. Quick ratio is quick asset upon current liabilities. And what is the meaning of quick asset? Quick asset is current asset minus inventories. This is a more stricter test of liquidity than current ratio. It does not consider inventory because it will take more time to realize inventory. The standard ratio is 1:1. Then the next ratio is cash ratio. This is even stricter than quick ratio. It only takes into account cash and bank and marketable securities divided by current liabilities. It is absolute liquidity of the business. That is, if all creditors come suddenly, then how much creditors you can pay, what portion of current liabilities you can pay from your cash, bank and marketable securities. Fourth ratio is defense, basic defense interval ratio. This ratio basically measures that for how many days you can meet your regular cash expenditure. And how do you compute it? Cash and bank balance plus net receivable plus marketable security divided by operating expense per day, daily operating expense, average daily operating expense. Net receivable means your debtors, bills receivable, even they can be realized and you can use the money for operating expense. In some books they don't consider receivable, they only consider cash and bank and marketable securities. But in the study material of the institute they have also considered net receivable. Then what is net working capital? Current asset minus current liabilities. What is equity ratio? Equity ratio means shareholders equity divided by net asset. Shareholders equity means equity share capital plus reserve and surplus. And net asset means fixed asset plus current asset minus current liabilities. So basically what portion of your net asset is financed by shareholder. And then debt ratio. Debt ratio means total debt upon net asset. That is what portion of your net asset is financed by the outside parties other than shareholder. So if this ratio is high, it means risk is high. If equity ratio is high, it means risk is low. Now next is debt to equity ratio, very popularly called debt equity ratio. So total debt upon shareholders equity. Usually we take long term debt, but if the problem is specified, you can take long term plus short term also. Is it right? So this ratio, if it is high, risk is high. These ratios are also called capital structure ratios. Next is debt to total asset ratio. So total debt upon total asset. So total asset means fixed asset plus current asset. And net asset means fixed asset plus current asset minus current liabilities. Again this ratio measures what portion of your total asset is financed by debt. If this ratio is high, risk is high. Then there is capital gearing ratio. Again tick mark important. Capital gearing ratio means fixed charges bearing security. Fixed charges bearing securities, that is those securities on which you pay fixed charges like interest or preference dividend. Fixed charges bearing securities, preference share capital, debenture plus other borrowed fund divided by, in the denominator it will be equity shareholder fund. Equity shareholder fund. How do you calculate equity shareholders fund? Equity shareholder fund is equity share capital plus reserve and surplus minus losses. So it measures the ratio of fixed charges bearing security to equity shareholder fund. Higher the ratio, higher the risk. Higher the ratio, higher the risk. If they ask you to comment, you can comment. And then we'll have proprietary ratio. Proprietary ratio means proprietary fund upon total asset. And proprietary fund means equity share capital plus reserve and surplus plus preference share capital minus losses and fictitious assets. That will give you proprietary fund. If this ratio is high, then risk is low. If this ratio is high, risk is low. It means more of your total assets are financed by the owners, and total asset will be fixed asset plus current asset. Fixed asset plus current asset is total asset. Now next is coverage ratio. Under coverage ratio we have debt service coverage ratio, that is how many times your earning is sufficient to pay interest and installment. That is earning available for debt service divided by interest plus installment. The standard ratio is 2. Higher the better. Higher the better. If this ratio is high, risk is low. If this ratio is high, risk is low. In case of coverage ratio, if the risk is high, if the ratio is high, risk is low. And then interest coverage ratio, EBIT upon interest. How many times your EBIT is sufficient to pay the interest? The ideal ratio is greater than 1. If this ratio is high, risk is low. Higher the better. If this ratio is high, interest coverage ratio is high, the company will be able to pay its interest easily. Next is, if they ask you to write a note on interest coverage ratio, you have to write all these points. Then another coverage ratio is called preference dividend coverage ratio, PAT upon preference dividend liability. Ideal ratio is greater than 1, higher the better. Higher the better. Higher the ratio, risk is lower. If ratio is high, risk is less. And then fixed charges coverage ratio, not very important but still note down, EBIT plus depreciation upon interest plus repayment of loan plus preference dividend also, because that is also fixed charge. So the ideal ratio is more than 1, higher the better. Higher the better. If the ratio is high, risk is low. In case of coverage ratio, if more profit is available, it is better. Okay. Now the next is total asset turnover ratio. These ratios are called activity ratio, efficiency ratio, performance ratio, turnover ratio. So the question in the exam can be, name 4 activity ratio, or they will give you a balance sheet and they will ask you to find out activity ratios. It shows the activity or efficiency in utilization of the asset. So total asset turnover ratio, sales or cost of goods sold upon average total assets. Wherever possible, we'll take average. Sale is for a period, so the denominator should also be average of the total asset utilized during this period. Higher the ratio, higher the capacity utilization. Lower the ratio, lower the capacity utilization. How many? What is the amount of sale generated per rupee of total asset? Okay, then similarly we have fixed asset turnover ratio, sales or cost of goods sold upon average fixed asset. If sale is available, use sales data. If sales data is not available, use cost of goods sold data. Higher the ratio, higher the capacity utilization, better the performance. Lower ratio means lower capacity utilization, poor performance. In case of turnover ratio, higher is better. Next is capital turnover ratio. Sales or cost of goods sold upon average net asset or average capital employed And what is included in capital employed? Will be shareholder fund plus long-term debt. Shareholder fund plus long-term debt. Or there is one more way you can reach that number, or you can take assets minus current liabilities. Asset side minus current liabilities will give you capital employed. Higher the better. Working capital turnover ratio, working cost sales or cost of goods sold upon working capital. Higher the ratio, higher the efficiency in utilization of working capital. Inventory turnover ratio, first priority will be given to cost of goods sold. If that is not available, then take sales, or if the institute asks you to take sales, then take sales. Divide by average inventory. Average inventory means opening stock plus closing stock by 2. Higher the ratio, higher is the efficiency. Debtors turnover ratio, credit sale, not total sale, credit sale. Divide by average account receivable. Account receivable will be bills receivable plus debtors. Higher the ratio, higher the efficiency. Then based on debtors turnover ratio, we have debtors velocity or called receivable velocity, also called debtor collection period, also called debtors collection period. So there are two ways you can compute it. One is average account receivable upon average daily credit sale. There is one more formula, 365 by debtors turnover ratio. You can mention this also. So if this data is available, use this data, otherwise use this data. Higher, this ratio shows how many days are taken to collect the data. Lower collection period is better. Lower collection period is better. Here, lower DCP is better. So that funds are blocked for lower number of days. And now we have payable turnover ratio. It means annual net credit purchase. Underline credit purchase. Don't take cash purchase upon average accounts payable. Accounts payable will be bills payable plus creditor. Okay. It tells you how many days on an average you take to make payment to your creditors. Then payable velocity, also called creditors payment period. Also called creditors payable payment period. Creditors payment period. Also called creditors payment period. Formula is average accounts payable upon average daily credit purchase. Write down one more formula, 365 divided by payable turnover ratio. 365 divided by payable turnover ratio. If you are given payable turnover ratio, then just take 365 divided by payable turnover ratio. So how many days do you take to make payment to the creditors? Okay. Then we will now see profitability ratio based on sales. GP ratio, gross profit upon sales. Net profit ratio, net profit upon sales. Operating profit ratio, operating profit upon sales. What is the difference between these two, net profit and operating profit ratio? In net profit, non-operating income and non-operating expenses are also considered. In operating profit ratio, only operating income item and operating expense item are considered to check the operating performance of the business. Then cost of goods sold to sales ratio, very easy, COGS upon sales into 100. And then operating expenses ratio, administration expense, selling expense, distribution expense upon sales. Then operating ratio is cost of goods sold plus operating expense upon sales. So if this operating ratio is known, you can compute operating profit ratio. So somewhere below you can also mention that operating profit ratio is equal to 100 minus operating ratio. Or suppose you have to find operating ratio, then you can say is equal to 100 minus operating profit ratio. 100 minus operating profit ratio. Financial expense ratio. Financial expense, like for example interest, preference dividend, they are called financial expenses. Divide by sales into 100. Next is profitability ratio, which are related to overall return on asset or overall return on investment. So very important, this return on investment. So return or profit upon investment. Higher the better. Overall, it tells you overall return on your investment. Then return on asset. Net profit after tax upon average total asset. Now there are two versions of this. One is before tax version, EBIT upon average total asset. This is before tax version. And after tax version is EBIT into 1 minus T upon average total asset. So it tells you how much is your rate of return on your total asset that you have invested. Total asset will be tangible and intangible asset and current asset also. Return on capital employed on pre-tax basis. EBIT upon average capital employed. You write it average. And on post-tax basis, EBIT into 1 minus T upon average capital employed. Higher the ratio, higher the performance. This ratio is useful to check how much on an average return the company is earning on its long-term capital employed. And then return on equity. This ratio tells you what is the return earned by equity shareholder. So we will take PAT minus preference dividend upon equity shareholder fund. Higher the better. Now next ratio is profitability ratio required for analysis from owner's point of view. EPS. EPS formula is PAT minus preference dividend upon number of equity share outstanding, that is earning available to equity shareholder. This ratio is useful for comparison with other company, with the same company, for valuation purpose also, for checking the growth rate also. Next ratio is dividend per share. Dividend paid to equity shareholder divided by number of equity share. One more formula write down. You can calculate dividend per share by multiplying face value or paid up value into rate of dividend. Then the next ratio is dividend payout ratio, DPS upon EPS. What portion of earning is distributed to shareholder in the form of dividend? Who are interested in this ratio? Shareholders, investors are interested in these ratios. Next is profitability ratio related to market or valuation or investor. So here one of the very popular ratios is price earning ratio. Market price per share upon earning per share. That is how many times is market price compared to earning per share. This ratio is you can use P ratio into EPS to calculate the market price of the share. Is it right? So this ratio is useful for computing market value of the share, P ratio into EPS. Then next is dividend yield. Dividend yield means DPS upon MPS. That is what is your return from dividend by comparing with the market value of the share. Okay. Then in the same way we have earning yield. Earning per share upon market price per share, or you can also write 1 by price earning ratio. Earning yield is reciprocal of P ratio. That is how much is your earning as a percentage of market price. Okay. How much is your earning as a percentage of market price? Then there is a book value multiple, a formula called book value multiple. Book value multiple is the ratio of market value upon book value per share, and book value per share is equal to net worth divided by number of shares. So what is the ratio of market price to book value? Book value is taken from balance sheet. These ratios are useful for comparison purpose and for valuation purpose. So the advanced version of this ratio is Q ratio, given by Mr. Tobin, one economist called Tobin. He says instead of taking book value, take the replacement cost of the asset. So the formula is market value of the company divided by assets replacement cost. That is how much will it cost to replace the asset. Is it right? How much will it cost to replace the asset? This ratio is not very popular in the exam or in general also. Just part of your syllabus. Okay. Now the next paragraph we will discuss is users and objective of financial analysis. Who are the users and what is their objective? Who are the people who are interested in the financial statement analysis of a company? So first general question is who are the parties who are interested in the financial statement analysis? Then second question they will ask you why they are interested. And third question is which ratios they will use for analysis purpose. Now different parties may use different ratios for their requirement. Like for example, a shareholder will use a different set of ratio. A creditor may use a different set of ratio, or a bank may use a different set of ratios. So who is the first party who is interested in ratio analysis? Shareholder. Why shareholder is interested? He is the owner of the company. His funds are invested. He wants to know whether this company will remain profitable or not. He wants to know whether this company will grow in future or not, whether his funds are safe or not, whether he should remain invested or not, or whether he should sell his share in that company or not. Is it right? He wants to know how much risk he is taking. So therefore, question would be for 2 marks. Name 4 ratios in which shareholder of a company would be interested. So shareholder of the company would be interested mostly in the profitability ratios. Why? Because his money is invested. Why do we invest in a company? To earn return, to earn profit. So therefore he would be interested in ratios like earning per share, dividend per share, price earning ratio, dividend payout ratio, and you add one more, return on equity. He will be interested in return on equity also. Return on capital employed. Is it right? Debt equity ratio. Who is the next user? The next user is investor. That is current investor and potential investor. Those who want to invest in the company. So those who want to invest in the company or who have already invested in the company, they are interested in knowing the overall financial health of the company. They will see what is the return of the company, what is the liquidity of the company, what is the risk in the company. So for that, they will be calculating many ratios, like they will be calculating profitability ratios. We have already seen profitability ratios, net profit ratio, operating profit ratio, return on investment ratio. Then you will be interested in capital structure ratios like debt equity ratio, proprietary fund ratio, total debt to asset ratio, capital gearing ratio. Then he will be interested in solvency ratio like current ratio, liquid ratio, cash to current liability ratio, and he also wants to know the efficiency of the company. So he will be calculating the turnover ratios also, asset turnover ratio, fixed asset turnover ratio, debtors turnover ratio, stock turnover ratio, working capital turnover ratio. Third party who is interested in a company's performance and liquidity position or financial position is lender. Why would a lender be interested in ratio analysis? Because the lender wants to check whether his funds are safe or not, whether he will get repayment or not, whether the company will be able to pay the interest and the principal in time or not. So which ratio a lender would be interested in? Coverage ratio. Name two coverage ratio in which lender would be interested. Debt service coverage ratio, interest coverage ratio. Then he will be interested in solvency ratio also, like current ratio, liquid ratio, because he wants to know company should have sufficient liquidity to pay his dues on time. Then turnover ratio, because he would be investing or lending to a company which is efficient. So company should have high asset turnover ratio, debtors turnover ratio, inventory turnover ratio, and he is also interested in profitability ratio. Because if the profitability ratios are good, the company can pay the interest and installment on time. So there is a bright chance that they will get their interest on time, installment of loan on time, principal on time. Just like lender, we have creditor. Why would creditor be interested? So same reason, creditor would be interested in knowing the financial position of the company, whether the company can pay their dues on time or not. Which ratio creditor would be interested in? Liquidity ratio. Example of liquidity ratio, current ratio, quick ratio. Okay, cash to current liability ratio. Then short-term solvency ratios, liquidity ratio, same thing. Next party interested is employees. Why would employees be interested? Because the employee will also like to work in a company which has a high profit, growth potential, regular payments. Okay, they are in a position to pay the salary on time or not. So therefore, employees are also indirectly interested. What are the ratios they would be looking at? One is liquidity ratio, because the company should be able to pay their salary, bonus and other staff welfare expenses on time. Second, they would be interested in long-term solvency ratio, because they want to work in a company where company will also survive for a longer period. So they would be checking which ratio? Debt equity ratio, total debt to total asset ratio. Then they also want to know the profitability of the company. So profitability ratio and return on investment. So in the exam they will ask you, name 4 ratios in which employee would be interested in. So this way you have to write the answer. Another party who is very interested in your performance is the government and the regulator. because accordingly the government will decide their fiscal policy, monetary policy, subsidy policy, tax policy, incentive to the entity, etc. Okay, tax policies are determined based on that. Subsidies are determined based on that. Interest subsidy are given based on that. Grants are given based on that. So they are interested in many ratios like profitability ratios. So you have to write in the exam which are the profitability ratios also. One of the most important stakeholders in the company is the management of the company because they are running the show. So management is also interested in ratio analysis. Under management also we have different divisions, different departments like production manager. So production manager, they are interested in knowing data about output, production, okay. Which ratio they may be interested, input output ratio, raw material consumption ratio. Then there are sales manager who are interested in ensuring that company has high sales are growing. So they would be interested in ratios like turnover ratio, like receivable turnover ratio. Then they are interested in several expenses ratio, like advertisement to sales ratio, selling and distribution expense to sales ratio, how much amount the company is spending on sales promotion. Then financial managers like you are interested in several ratios to check the financial health of the company. So they would be interested in almost all the ratios that we have learned, especially profitability ratio, return on investment, turnover ratio, capital structure ratio, because accordingly they have to take the correct measures also. Is it right? It is the financial manager on whose broad shoulders the company's finances are dependent. So they analyze various ratios to take corrective actions if it is not up to the mark. And then don't forget, a company has got a CEO or a general manager. The performance of a company to a large extent depends on the efficiency of the CEO. It is like a report card of the CEO. So therefore CEO also is interested in all ratios because he is responsible for sales, he is responsible for production, human resource, inventory, marketing, everything. Next point is different industries. Now I will tell you one interesting thing. In different industries there are different ratios used for understanding the performance or comparison or understanding the growth. For example, if you are a telecom company, then many ratios are related to their calls and subscribers. For example, they calculate how much is revenue per subscriber. How much revenue per subscriber. That is called ARPU, ARPU, average revenue per user. Telecom company. So Bharti Airtel says we have 200 rupees ARPU. Jio says we have 220. Oh, Idea Vodafone says we have 30 rupees only because now customers are running away. So that shows which company is doing good. Okay. Then in case of banks, they would be calculating ratios like loan to deposit ratio, operating expenses and income ratio. If you are a hotel, then you calculate room occupancy ratio. So if you have 100 rooms, but only 60% are occupied, that is called room occupancy ratio. Airline companies, they see how many seats are used. Is it right? Bed occupancy ratio. If you are a transport company, you calculate ratios like passenger kilometer, operating cost per passenger kilometer. So the list is not exhaustive. Different industry may have some more ratios for evaluating their performance. Like as I have told you, in case of telecom company, ARPU. Which ratio telecom company uses? ARPU. average revenue per user, average revenue per user, like that. This was just an example, they are not going to ask you. Next is application of ratio analysis in decision making. Tick mark important. The question they ask is here, why ratio analysis is important? Why ratio analysis is important? A theory question. So ratio analysis is very important in business, very useful for several stakeholders like, as we have seen, shareholder, investor, management. Balance sheet, P&L account, cash flow statement may not tell you the performance clearly or liquidity position clearly. So we use the balance sheet, P&L account, and we do ratio analysis so that we can understand the profitability, the financial position, the liquidity, the risk, the growth of a company, right? So first benefit of ratio analysis is it helps us to understand the liquidity position, whether the company has sufficient liquidity to pay its short-term obligation or not. Is it right? And for that they measure ratios like current ratio, quick ratio, cash to total current liability ratio. Second advantage of ratio analysis, they will help us to understand the long-term solvency of a company, whether a company will be able to sustain in the long run or not. Because as an investor, as a lender, as an employee, we want to be sure that this company would be able to sustain in the long run. So therefore we compute ratios like debt equity ratio, proprietary ratio, total debt to total asset ratio, capital gearing ratio, profitability ratios. Okay, and that helps us to evaluate the long-term solvency position. Which is the next benefit of, what is the next benefit of ratio analysis? Very important, operating efficiency. If you look at the P&L account, you will only get figures of sale, expense, which will be in lakhs and crores. You don't really understand the efficiency. But if you do ratio analysis, you'll be able to see whether company is efficient or not. You can compute their net profit ratio, gross profit ratio, operating profit ratio, sales expenses to sales ratio, turnover ratios, and you will be able to check the operating efficiency. Then we have operating profitability, overall profitability. Why are you investing in a company as a shareholder or as an investor? You are investing because you are interested in earning profit. So does ratio analysis help you to understand the profitability? Yes. Name at least 2-3 ratios which help you to understand the overall profitability. Return on investment, return on equity, return on capital employed, return on total asset, ROTA, return on net asset, RONA, ROTA, RONA, ROE, ROE, okay, ROCE. And these are useful for not only management but also for other stakeholders like shareholder, investor, creditor, lenders. One of the major benefits of ratio analysis is inter-firm comparison. If you have to invest in say Infosys, the other comparable company is TCS or Wipro. Okay, then what you will do, you will take the ratios of all the 3 companies, because ultimately you will think that my risk is going to be the same. Then why not to invest in a company which gives me a higher return, which has got better potential, etc. So one can compare 2 or more companies and understand which company has been performing better. So this is very useful for investors. Another advantage of ratio analysis is you can use ratio analysis for budgeting purpose also. Based on your trend, you can prepare next year budget. You can prepare next year sales budget. You can prepare purchase budget. Okay. One of the chapters that you learn in cost accounting subject is budgeting. But the base of that budgeting is ratios also. If your cost of goods sold is 60% of sale, so if you know the sales, you will know cost of goods sold. From cost of goods sold, you can also estimate how much purchases do you need. So if the sales department gives you sales estimate, using the GP ratio or cost of goods sold to sales ratio, we can estimate the purchases. This was just an example. So companies prepare their next year budget based on the ratios observed in the current year. That is the benefit of ratio analysis. Now the question is, what are the limitations of financial ratios? Limitation means certain drawbacks. There are some drawbacks or some challenges in using ratio as it is. Okay. So first challenge of using ratio is, if the company is into diversified product line means a company is into multiple businesses. Diversified means multiple businesses. Let's say for example ITC company. If you take total sales and total gross profit, it will not give you a correct picture, because that gross profit will include gross profit of tobacco business, hotel business, paper business, agri business, FMCG business. So then what we should do in such diversified product line companies, instead of calculating ratio for the entire company, we should compute the ratio for the business segments. Is it right? Different businesses in which they are invested or involved, and compute ratio business wise. That will help us to get the picture better. Another problem with ratio analysis is that when we are comparing different years' performance, it is not directly comparable because of inflation. Inflation means high prices. So same raw material price must have gone up. Same inventory price must have gone up. So current year and previous year may not be comparable. If the inflation is high, then we will not be able to make correct comparison across different timelines. One more challenge with ratio analysis is seasonal factors. What is seasonal factor? That means in some businesses you have more sales in certain time period and less sale in other time period. So if you are comparing on quarter to quarter basis, quarter 1, quarter 2, quarter 3, quarter 4, these are the 4 quarters in a year. Is it right? So some quarter like 3 may have high revenue, high inventory, because demand for that product may be more, and in some quarter the demand may be less, sales may be less, inventory may be less. So if you are trying to compare, suppose it's a woolen garment, easy to understand example, you will have better ratios in third quarter. Third quarter in India is October, November, December. First quarter is April, May, June. Now woolen garment will sell more in November, December. So that time the ratio would be high, better ratios. Whereas in some months the ratios will be very poor. So when you are dealing with a company which is into seasonal operation business, one has to take the seasonal factors in mind. Otherwise, you can make a wrong interpretation. You can make a wrong conclusion. Okay, suppose a company sells air conditioners. So which month? Summer. So second quarter or first quarter will have more sale. First quarter, April, May, June, buying sales, high inventory, more profit. Then what happens in the third quarter? November, December, October. People don't buy much, sales go down, inventory level goes down. There can be losses also because fixed overheads will be there. So as a result of that, we have to be careful when we are using companies which are into seasonal business. Then year-end adjustment. Another problem is what? Companies, in order to do makeup of the balance sheet, what is called window dressing. What is window dressing? Makeup. Okay, you look more beautiful than you really are because of makeup. Make up. You try to improve artificially. That is why it is called make up. Okay. So companies also do makeup of their balance sheet and P&L account by year-end adjustment. What do you mean by year-end adjustment? See, balance sheet is a point figure. The balance sheet which is on 31st March is used by the analyst. So 5 days, 10 days before, if they have suppose a current ratio which was less than 1, then they will improve the current ratio by borrowing money. If they borrow money, bank account debit to loan account, bank balance will increase. If bank balance will increase, current ratio will increase. Yes, if I have got surplus money, my bank manager also calls on 31st March or 1 or 2 days before, and he says, sir, please put some money in the account so that we'll have better ratios. Happens. Is it right? In order to increase sales, what they do, in the month of March, they will book lot of sales invoices. And sometimes they pass entry for sales return in the month of April. So first you book sale. So ratios which are related to sales, those turnover ratios will go up. And next year you do the sales return entry. If you want to reduce debt equity ratio, then towards the end you repay the debt. Again next year beginning you borrow. Even sometime my bankers call me and say, sir, you deposit money right now, but withdraw it on 2nd of April. At least my ratios will be very good. That is called year-end adjustment. Year-end adjustment or window dressing. They try to give better picture of the balance sheet than what it was throughout the year. So throughout the year current ratio may be less than 1, but year-end adjustment will make it more than 1. Throughout the year debt equity ratio may be 3:1, but year-end adjustment may make it 1:1 or 2:1. Okay, turnover ratio may be 2:1, year-end adjustment may make it 2.5:1. One more challenge with the ratio analysis is that if different companies are following different accounting policies, their profitability will not be comparable. Financial statement will not be comparable. One company may follow straight line method, one may follow WDV method. So their fixed asset figure can change. One company may follow FIFO method for inventory valuation, one may follow weighted average. Stock may not be comparable. Depreciation policies are different. Amortization policies for intangible assets are different. So because of that, making comparison of two entities with different accounting policies will be different. Even the same firm, if it is using different accounting policies in different year, for same firm also, the comparison is difficult. So that is why we have an accounting standard in India, AS1, disclosure of accounting policies. Why that standard is there? Because of this point number 5. If companies are using different accounting policies, the investor will take care of the fact that they are using different accounting policies, and then he will make the comparison. And point number 6 is there is no standard set of ratios against which a firm's ratios can be compared. Ratio analysis is not a rocket science where everything has to be perfect. It varies from company to company, business to business, time to time, size of the organization. Okay. So if you are a banking company, your debt equity ratio will be high because your business is to borrow money and lend money. But if you are a software company, debt equity ratio will not be high. Today in the morning I was looking at debt equity ratio of Reliance. It was something like 0.3, 0.4. But when I looked at the debt equity ratio of TCS, it was 0. And in some case it was 5. So it varies. Similarly, current ratio can vary. If you are a manufacturing company like a steel company, cement company, you have to carry lot of raw material because raw materials are not easily and quickly available. So they carry lot of raw material. Then they have work in progress. Factory sizes are huge. Lot of finished goods they have to keep. Debtors are also there because they are in a competitive business. So they have to give credit to all their customers, to most of the customers. But if you are a service company, let us say you are a Infosys software company, you don't need raw material. You don't need work in progress, finished goods like that. And because of the business, they usually take advance from the customer. They take a major portion of the work that has to be done in the form of advance from the customer. So that is why they may not have a high current ratio. So there is no standard set of ratios to come to a conclusion. So one has to see what kind of industry is that, what kind of business is that, what is the size of the business, and then you can form a conclusion. And the same point is repeated here. Difficult to generalize whether a particular ratio is good or bad. Is current ratio 3:1 good or bad? 3:1. For some company 3:1 is good. But for some company it may be bad because you are carrying excess liquidity. You are carrying excess liquidity. You are keeping inventory, debtor, cash in hand, prepaid expense, bills receivable, which do not generate any profit. They are idle funds basically. So therefore it can be good for one party but bad for another entity. Debt equity ratio can be good if it is 6:1 for a banking company, NBFC, non-banking finance company, debt equity, but bad for a service company. Okay. One has to look at the industry. Current asset 3:1 ratio. Okay, one student is asking a question. Yes. It's a good ratio. Yeah. Then you have to go inside the current asset. What are the composition of current asset? Then what is the business you are doing? Then you have to conclude. So without understanding the business model and the industry and the composition of those current assets and current liabilities, it may not be so quickly easy to say that this is good or bad. But as a student, we have to just understand the basics part. And the next point is financial ratios are not interrelated, are interrelated, not independent. Very interesting point. If you just look at one or two ratios, you may come to a wrong conclusion. One is to read multiple ratios. Look at profitability ratio, look at liquidity ratio, look at the capital structure ratios, and then you should form an opinion about a company. So when you go to a bank for taking a loan, the bank does multivariate analysis before they give you the loan. What do you mean by multivariate analysis? It means they will calculate several ratios. They will calculate several ratios. Then they will come to a conclusion whether this customer is to be given loan or not. So what banks do, they will calculate many ratios then they will give them weightage, give them weight. For example, they have a matrix. If the ratio is between this and this, I will give so much weight. Then they calculate the total. It's like mark sheet. Like in current ratio, they will say if it is between 0 to 1, I'll give a mark of 0.5. If it is between 1 and 2, 0.7. More than 2, 0.9, something like that. So for every ratio, they have a marking system. Take the total of those marks. It's like in every subject you have a marking system. And after that, if the total exceeds a certain mark, then they take decision to give loan or not. So one ratio may be bad, but some ratios may be good also. So debt equity ratio may be bad, but your return on investment can be very high. Is it right? So therefore ratios are not independent. Ratios are interdependent. They depend on each other. So one should not come to a conclusion by looking at few ratios only. One has to read many ratios before we come to a conclusion. Now we'll take one more paragraph for discussion. Financial analysis is done in two ways. One is called horizontal analysis and one is called vertical analysis. So what do you mean by horizontal analysis? Suppose year 2022 is given, 2023. So that is horizontal. Is it right? Then you are given current ratio. This was 1.5, 1.8. So we will say current ratio has improved. So when we are comparing one year with another year, this is called horizontal analysis. Okay. Comparing different years ratios. Comparing different years ratios is called horizontal analysis. Then vertical analysis means, suppose we are in year 2023, gross profit is 100, sales is 500, GP ratio 100 by 500, 20%. So when we take the same year and take the data from the same year column, so can you see it is vertical and this was horizontal, year 1, 2, 3, 4. Whereas when you take the figures of same year and do the ratio analysis, then it is called vertical analysis. So vertical analysis means you can compare two firms in the 2023. So horizontal analysis will be useful for year-wise analysis. Vertical analysis is useful for comparing one firm with another firm in the same year. Okay, now we'll solve some important questions on ratio analysis. Is it right? Some important questions we will solve on ratio analysis. So please come to question number 14. Question is, Gig Limited has the following information relating to year ended 31st March 2020 and 31st March 2021. Gig Limited. Share capital, reserve and surplus, long-term loan, net profit ratio 8%, GP ratio 20%. Long-term loan has been used to finance 40% of the fixed asset. This is the long-term loan. So long-term loan is used to finance 40% of the fixed asset, which means fixed asset is equal to, or fixed asset into 40% equal to long-term loan. Can I say that? 40% of the fixed asset is long-term loan. So long-term loan is 30 lakh. Divide by 40% if I do. So that will give me the amount of fixed asset. Can anybody guide me? So fixed asset is 75 lakh. There is no name to this ratio. It is a ratio between long-term loan to fixed asset. Is it right? So basically they have used the formula loan upon fixed asset is 40%. Loan upon fixed asset is 40%. There is no standard name for this ratio. Stock turnover with respect to cost of goods sold is 4. Debtors represents 90 days sale. Company holds cash equivalent to 1.5. This is 1.5 months. Not 11 by 2. It is 1.5 months. 1.5 months of cost of goods sold. Then ignore tax. Very good. When they say ignore tax, enjoy and assume 360 days in a year. Then they have given you the balance sheet. You have to fill in the blanks in the notebook. Prepare balance sheet on 31st March 2021. Is it right? So from the limited information, you have to find lot of missing data. Question number 14. So write down. But first you look at this balance sheet carefully. There is a hint here. Share capital has not changed. This is a new problem. New type. Mark important. Source is study material of the institute. Share capital no change. But if you look at the reserve and surplus, it was 20 lakh. Now it is 25 lakh. So why the reserve and surplus has gone up? Because of current year PAT. Because of current year PAT. So can you guess what is the PAT of the current year? PAT of the current year is 5 lakh. Suppose opening balance is 20 lakh. Current year profit 5 lakh. So closing reserve will become 25 lakh. If PAT is 5 lakh, you can compute the sales figure because PAT is 5 lakh. Net profit is 8%. So from PAT, you can calculate sales. From sales, you can calculate gross profit. From gross profit, you can calculate cost of goods sold. From cost of goods sold, you can calculate cash and stock. From sales, you can calculate debtors. Is it right? So once you get cash, stock, debtor, and you've already got the fixed asset from loan, you can get the asset side total. So creditor will become balancing figure. Can I say creditor will become balancing figure? Because from the information, you can find out all other figures. Creditor will become balancing figure. These three are already given to you. Is it right? So this is a good question. So first you write down this balance sheet in the notebook. Right? Balance sheet. Write in the notebook this format. Balance sheet as at 31st March 2021. Same copy. When the institute gives you format, use the same format. Question is from study material. Are you ready now? Share capital, write down. How much share capital is given? Reserve and surplus closing, write down 25 lakh. Long term loan, write down 30 lakh. Other figures we have to find. This is a question of finding missing number from the given ratios. Ready? Now you write down below working notes. Working note 1, write down calculation of current year's profit. Calculation of current year profit. So write down current year profit is equal to closing reserve and surplus minus opening reserve and surplus minus opening reserve and surplus. So that is 25 lakh minus 20 lakh, because there is no other information given. So we will assume the entire 5 lakh is current year profit. They have not mentioned about any dividend paid, otherwise that will affect our answer. Okay. Assumption: no dividend has been paid. Assumption: no dividend has been paid. Now we will calculate working note 2, calculation of sales. Right hand side rupees. What is the net profit of this company for the year? 5 lakh. And in the question, what is net profit ratio? 8%. Therefore, sales will be A by B. 62 lakh 50,000. This is understandable format. Working note 3, calculation of cost of goods sold. Right hand side rupees. Point A, sales 62 lakh 50,000 less gross profit. What is gross profit ratio in the problem? 20% into 62.5 lakh, 12 lakh 50,000. Therefore, cost of goods sold A minus B. Presentation is important. Every line is understandable. And you could divide your answer into small points. Psychological advantage. They will give more marks. They will think each point is 1 mark. Okay. Calculation of stock. So you have to write stock equal to cost of goods sold upon stock turnover ratio, stock turnover ratio, cost of goods sold 50 lakh, stock turnover ratio 4. Therefore, the answer is 12,50,000. Is it right? Working note 5, write down calculation of debtors. What is the debtors collection period in the problem? Debtor collection period is 90 days of sale. Okay. And how much is sales figure? 62,50,000. Which means debtor will be equal to 90 divided by 360, because the problem says 360 days. For easy calculation only, proportionate will take 1560 to 500. Working note 6, write down cash in hand is equal to 1.5 months divided by 12 months into COGS as per the note given in the question. As per the note given in the question, 1.5 divided by 12 into 50 lakh. Come on. 6,25,000. Last working note 7. Calculation of fixed asset. This will complete asset side. Write down long term loan is rupees 30 lakh. 40% of fixed asset is 30 lakh. Therefore, fixed asset is 30 lakh divided by 40% is how much? 75 lakh. Up to this, write down properly. Any query you are welcome to ask. Anybody, any query? Yes. If you practice such questions, you will be able to handle the exam. Otherwise, it may not have come to your mind that the difference between closing reserve and opening reserve can be net profit, and that is your starting point. Without that, you can't get the stock, debtor and cash in hand figure. 4 marks or 8 marks, somewhere between 4 to 8 marks. So come back to your balance sheet. Fixed asset, just now you got some amount. How much was that? Fixed asset 75 lakh. Debtor, how much we had got? Debtor 1560 to 500. Closing stock, how much you had got? 12,50,000. Cash in hand, how much you had got? 6,25,000. So you please tell me the total of the asset side first. Asset side minus other items of liability side will give you sundry creditor. Sundry creditor will be balancing figure 1437. And what is the total of the balance sheet? 1 crore 9,37,500. 1 crore 9,37,500. This way you will write the total and then close the answer. Have you done? Please complete it. Once you complete, let me know. We'll go to next question 15. Question number 15. This question was asked in October 18 MTP for 5 marks. Write down important. Similar questions have been asked in past exams. And what is new about this question? You will get bills receivable and bills payable also in the problem. Okay. Debtor velocity is 3 months. What is debtor velocity? Debtor's collection period. Very good. 3 months means 3 by 12 of credit sales. Okay. So once you want to find debtor, 3 by 12 of credit sales. Same thing for creditor. 2 months. It means creditor's payment period. How many days or months on an average do we take to make payment to creditor? 2 months. So if you have to find creditor, 2 by 12 of credit purchases. 2 by 12 of credit purchases will give you creditor figure. Then stock turnover ratio is 1.5 times. Gross profit ratio 25%. Bills receivable, bills payable. So debtors will include bills receivable. Creditor will also include bills payable. So by applying the formula, if you get debtor figure, it includes bills payable also. Bills receivable and bills payable. GP, this is my starting point. Because only one figure is given. Sorry, gross profit is given. So from gross profit, we'll calculate sales. From sales, we'll get cost of goods sold. Then from sales, we'll get debtor. From COGS, we'll get stock. Using these two, we'll get purchase. From purchase, we'll calculate creditor. Is it right? So one has to understand which answer will lead to which place. And then fixed asset turnover ratio is 4. So from sale you can get fixed asset also. So what is the question? Sales. So sales will get from GP ratio. And cost of goods sold. From sales and GP will get cost of goods sold. Then sundry debtor. From sales and your debtor velocity, you will get debtors. From COGS and stock, you will get purchase. From purchase, you will get creditor and using creditor velocity. Closing stock will get using COGS and stock turnover ratio. You will get the stock. And then we have fixed asset from this ratio. There is a note, closing stock is more than the opening stock by 10,000 rupees. So you have to find out first average stock. From average stock you will get the closing stock, because opening stock and closing stock has a difference of 10,000. So you have to find out closing stock, right? So what will be my starting point in this question? Using gross profit and GP ratio, we can find out the sales. Once you get sales, then a lot of answers you can easily derive. So first you write down step 1, calculation of sales and cost of goods sold. Right hand side rupees point A, gross profit. We can go by formula also. Presentation can change. GP ratio. How much is GP ratio? 25%. So therefore sales A by B, 4 lakh divided by 25%, 16 lakh. And point D, cost of goods sold, C minus A, 12 lakh. And one more thing, write down, E, stock turnover ratio, is 1.5 times. So F, average stock, D by E. How much is average stock? Average stock is 8 lakh. So in the heading, write down calculation of sales, cost of goods sold and stock and average stock. You could have prepared 3 working notes also. Is it right? Choice is yours. Now from average stock and opening stock, we will calculate closing stock. So step number 2, calculation of closing stock. Average stock is opening stock plus closing stock divided by 2. Average stock is how much? 8 lakh. Opening stock, assume X. Closing stock will be X plus 10,000. Closing stock is 10,000 more. Divide by 2. Therefore, X equal to opening stock equal to 7,95,000. Therefore, closing stock 7,95,000 plus 10,000, 8,05,000. Is it right? Now we will find out step 3, calculation of purchases. Because to find creditor, I need purchases. Purchases equal to cost of goods sold plus closing stock minus opening stock. Is it right? Can I put these two in a bracket? Closing stock minus opening stock. COGS is how much? 12 lakh. Difference between closing stock minus opening stock is 10,000. You don't have to write both the figures. Save time. Or you can write 8,05,000 minus 7,95,000. But if you have understood, then just write 10,000. So how much it comes to? Purchases is 12,10,000. Why do I need purchase? To find creditor. Any query on step 3? No query? Okay. Step 4, calculation of creditors. creditor velocity is equal to how many months? 2 months. Debtor is 3 months. Creditor is 2 months. So it means creditor plus bills payable is equal to 2 by 12 into credit purchases. 2 by 12 into credit purchases. Assumed all purchases are credit. No need to write also. Now creditor figure we don't know, but bills payable we know. How much is bills payable? 10,000 is equal to 2 by 12 into credit purchases 12 lakh 10,000. Now after solving this equation on your calculator, you will tell me what is creditor equal to. 1 lakh 91,667. 191,667 is right. Any query on this? In the same way, we'll calculate debtors also. Step 5. Presentation is important. Everything you have to write. So what is given to you? Debtors velocity. How many months given? 3 months. It means debtor plus bills receivable represent 3 by 12 into credit sales. But if nothing is given, all sales are credit. How much is debtor missing? Bills receivable figure is there. 25,000. 3 by 12 into credit sale was how much? 16 lakh. Solve. Therefore debtors final figure 3,75,000. Last working note. So we have found sale, cost of goods sold, debtor, creditor and closing stock. What is pending? Calculation of fixed assets. For that they have given fixed asset turnover ratio 4 times. Fixed assets turnover ratio is 4, which means sales upon fixed asset is equal to sales is upon fixed asset equal to 4. So fixed assets equal to 4 lakh. Now this question is not clear whether fixed asset turnover ratio is based on sales or cost of goods sold. So I will write one more answer. Up to this we have written. If you look at the institute answer, they have taken cost of goods sold for this ratio. But we will solve by both, because your institute in the exam they can deduct marks. So when you are in doubt, both. Alternatively, COGS divided by fixed asset is 4. 12 lakh divided by fixed asset is equal to 4. Fixed asset equal to rupees 3 lakhs. Okay. This way you'll solve this question. Good question for exam purpose. Now we'll come to question number 16. Question is from May 18 RTP. Okay. Following figures are available in the books of Tirupati Limited. Fixed asset turnover ratio 8 times means sales upon fixed asset. Capital turnover ratio 2 times means sales upon capital employed. Inventory turnover ratio, cost of goods sold upon average stock. Is it right? Receivable turnover ratio, credit sale upon average receivable. Payable turnover ratio, credit purchases upon average creditor. GP ratio, GP upon sale. GP during there is 8 lakh. So this is my starting point. Is it right? From GP you will get sales. From sales you will get cost of goods sold. And then fixed asset turnover ratio is given. So you can get fixed asset, you can get capital employed, you can get debtors. Then from COGS you can calculate stock. From COGS and stock you can get purchases. From purchases you can get creditor. There is no long-term loans or overdraft. So in balance sheet there is no long-term loan or overdraft. Reserve and surplus is 2 lakh. So once you get capital employed here, capital employed minus reserve and surplus will give you share capital. Is it right? Closing stock is more than opening stock by 20,000. So that I will require here for calculating purchases. Calculate various assets and liabilities and prepare a balance sheet of Tirupati Limited. This you can delete. And prepare balance sheet of Tirupati Limited. Is it right? This question has not given us whether this fixed asset turnover ratio, capital turnover ratio, whether they are based on sales or whether they are based on COGS. So that is a very challenging problem before the student. Is it right? So what we'll do, we'll first solve by sales figure. If it is not going to tally, then we are going to change by using cost of goods sold. Only after looking at the institute's answer, I got to know that they have used cost of goods sold figure instead of sales figure for fixed asset turnover ratio and capital turnover ratio. How will the student know in the exam? Is it right? So you have to take a chance to start. Little torture for the student. First working note step 1 write down. You can first calculate the answer, then prepare balance sheet. Or first you can write balance sheet and then write working notes one by one. Both way you can present. Is it right? Calculation of sales, cost of goods sold and average stock. So in one table we will get 3 answers. First you write down gross profit. Question in front of you. How much is gross profit? Gross profit is 8 lakh. Very good. Amazing. And how much is GP ratio? GP ratio is 25%. So therefore, sales is equal to A by B. Is it 32 lakh? Yes. Point number D. Cost of goods sold C minus A. 24 lakh. Point number E. Stock turnover ratio. Any other presentation is also welcome. You will not lose mark, don't worry. So what is the inventory turnover ratio given in the question? Inventory turnover ratio 8 times. So point number F, you will get average stock. Average stock will be D upon E. D upon E. So that is 3 lakh. Now from average stock and the difference between opening and closing stock is 20,000. We will be able to find out the opening stock figure and closing stock figure both. Is it right? So step number 2. Calculation of closing stock. So this is another type of question they ask in the exam. Average stock is equal to opening stock plus closing stock divided by 2. Average stock is 3 lakh. Opening stock assume X. Closing stock assume X plus 20,000 divided by 2. So student will solve and give me the answer. What is X equal to? X equal to 2,90,000. And what is closing stock equal to? You will add 2,90,000 and 20,000 more. So that gives you 3,10,000. Then step 3 will find purchases. Calculation of purchases. Purchases equal to cost of goods sold plus closing stock minus opening stock. Can I write closing stock minus opening stock in one bracket so that you can just write 20,000 directly? Cost of goods sold previous table 24 lakh. Difference between closing stock and opening stock is 20,000. So this comes to 24 lakh 20,000. Is it right? So can I use this figure to find out the creditors now? For creditors, payable turnover is given. Payable turnover. So using payable turnover and purchases figure, we can find the creditor figure. So step number, how many steps you have done? This is 4. Calculation of creditor. Payable turnover ratio. Payable turnover ratio is equal to purchases upon creditor. So can I say creditor is equal to purchase divided by payable turnover ratio? How much is purchase we have computed just now? 24 lakh 20,000. And how much is payable turnover ratio in the problem? Payable turnover ratio is 6. So student will give me the answer. Round off the last digit. 4 lakh 3,000. 3. Is it right? Step 5. calculation of debtors. Debtors equal to sales upon receivable. I am not writing average receivable because average is not possible in this problem. Is it right? So what you are getting is average receivable, but that will be my final answer also. How much was sales you have computed? And how much is your receivable turnover? Receivable turnover ratio? Receivable turnover ratio is 4 times. 32 lakh divided by 4 times. So debtor would be 8 lakh. So up to step number 5 there was no problem. The problem is in step number 6 and 7. Step 6. Calculation of fixed assets. Fixed asset equal to sales upon fixed asset turnover ratio. Yes or no? Sales upon fixed asset turnover ratio. Sales is 32 lakh. Fixed asset turnover ratio 8. Answer 4 lakh. Step 7. Calculation of will calculate by COGS also. Okay. Alternatively, right here. Fixed asset equal to COGS upon fixed asset turnover ratio. We will see which answer will help us to tally the balance sheet, because balance sheet is also asked, so balance sheet should tally. Is it right? If only fixed asset was asked, then first is enough, because we use sales figure. How much is COGS? Divide by 8. Answer. Step 7. Calculation of capital employed. Capital employed equal to sales upon, come on, capital turnover ratio. Sale is how much? 32 lakh. Capital turnover ratio 2. 16 lakh. Write alternatively. Capital employed equal to COGS divided by capital turnover ratio. How much is COGS? Divided by 2. Answer. One more working note. Step 8. Calculation of share capital. Share capital equal to capital employed minus reserve and surplus. Is it right? So here we'll have two answers. Alternative one answer will be share capital equal to, if I take 16 lakh and reserve and surplus is given in the problem. How much? 2 lakh. So then my answer will be 14 lakh. And if I use second alternative, that is if I use COGS, then my capital employed is 12 lakh minus 2 lakh is equal to 10 lakh. Is it right? Now wait, we will check on calculator whether COGS will help us to tally the balance sheet or sales will help us to tally the balance sheet. Okay. What are the items on the liability side? First you check. You have share capital, you have reserve and surplus, and you have creditor. So what is the total you are getting? If I take share capital, how much is share capital if I take on sales basis? 14 lakh. Reserve and surplus was 2 lakh. And creditor was how much? 4,03,333. On the asset side, fixed asset on sales basis was how much? Fixed asset was how much? When I use 1 minute, I'll check. 4 lakh. And if I use COGS as a basis, then it is 3 lakh. First you have to wait. I will check which answer is right. Okay, suppose you are stuck in the exam. You have to check which is right. And then what is my stock? Closing stock is 3,10,000. That will be same. Debtor will also be same. How much is debtor? Debtor will also not change. 8 lakh. Okay, debtor. So if I use sales figure, other current asset will be balancing figure. Other current asset will be balancing figure. So tell me how much is other current asset in sales column. Four lakh. And suppose I take cost of goods sold as a base, share capital was how much? 10 lakh. Then my other current asset will be this will be 16 lakh 3,330. 1,93,333. Write both the answers. Here there is a difference of 4 lakh. Here the difference is 1 lakh. So 4 minus 1, 3 lakh difference. So exactly the difference is 3 lakh here. So now you write down balance sheet. balance sheet, write down heading balance sheet. Heading, write down balance sheet. Then under balance sheet, write down two columns: sales basis, COGS basis. Sales basis, COGS basis. Sales basis and COGS basis. Now you can copy. Sales basis column, you will write share capital 14 lakh. COGS basis, COGS basis, you will write 10 lakh. Now the institute can't deduct marks, okay, because you've written everything. So even if they try to deduct marks, they will fail in their duty. Reserve and surplus will be same because this figure is given in question, 2 lakh, 2 lakh. Creditor figure will be same. It is based on purchase, 4 lakh 3,333. 4 lakh 3,333. Fixed asset figure will change. Fixed asset figure will change. It will be 4 lakh or 3 lakh. Remaining figure, stock and debtor, will not change. 3 lakh 10,000, 3 lakh 10,000. Debtor will be same, 8 lakh, 8 lakh. Other current asset is a balancing figure and therefore this will change. According to assumption, your answer can change. So instead of writing only on basis of one assumption, what I did, I solved by both the assumptions. If suppose other current asset figure was also given to you, and then if the balance sheet does not tally, then you have to take only that column in which balance sheet will tally. In one exam they had given that figure and the balance sheet was not tallying. Then the student was worried why it was not tallying, which means probably the fixed asset turnover ratio and capital turnover ratio was based on cost of goods. Little dangerous question. It is also not appropriate on the part of the institute to give a question like this without specifying whether the turnover ratios are based on sales or cost of goods sold. Usually these two ratios are based on sales. Now any query on this question number 16? 17 on your own. Come to question number 18. Question number 18. From the following table of financial ratio of R textiles, comment on the various ratios given at the end. Very good. This is a question of comment only. No need to calculate anything. The source of this question is May 2019 RTB. So even this kind of questions have been asked in the past exams for 4 marks, and these are good questions because it helps you to understand whether the student is conceptually clear or not, because you should know what is happening. Current ratio was 2.2, 2.5, 2.5. Current ratio of last 2 years is given and industry average is given. So first you have to check whether as a company are my ratios improving or not, and then you have to see whether compared to the textile industry what is my status, how have I performed compared to last year, how I have performed compared to the industry. So you will quickly participate, only will discuss as a homework you will write in the notebook on your own. So current ratio has improved. Current ratio has improved in the current year, and it is also matching with the industry average. In the first year it was below industry average, but in the current year they are able to match the industry average. So liquidity position is good. Then quick ratio in the first year was as per industry average. Current year it is slightly better than the industry average, which means the liquidity position is good because it is more than the industry average. But one can also see that there should not be idle funds. Too much of liquidity means idle funds are involved. So because we don't have enough data, we don't know the kind of business they are doing, we really can't comment, but it is also possible they have idle funds. What about receivable turnover ratio? It is constant and it is as per the industry standard. So there is no problem with receivable turnover ratio. What about inventory turnover ratio? It was 9, it was 10, and industry is 6. So this company has got a higher inventory turnover ratio. Inventory turnover ratio is increasing and it is higher than the industry, indicating efficiency in the inventory management. Receivable turnover ratio has decreased by just 1 day and it is slightly above the industry average. So again, not a major source of concern. Industry is 85, we are 86. 1 day is not a very significant difference. Is it right? Now let us look at the profitability ratio. Return on investment is decreasing. For the entity, return on investment is decreasing, but still it is very high than the industry. So they should try to keep the return on investment high only, not let it fall. What about operating profit margin? It has been maintained and it is very higher than the industry. Compared to 10%, they have got 19%, which is very good. Their operating efficiency is very good compared to other players in the same industry. What about debt equity ratio or debt ratio, debt to total asset? It has decreased slightly, which is nice, and it is even lower than the industry average. So the risk of this entity is lower than the other players in the industry. So risk wise also it is lower. And what about return on equity? Return on equity has improved in the last year compared to previous year, and it is very high. So this company has performed better than its competitors, peers, and the industry. So if you have this kind of data, you can say yes, this company is good and we can invest in this company. So this way you have to comment on the liquidity position, operating profit, financing, and return to the shareholders cost of capital. Okay, you will be able to solve such question. Okay, now we'll come to question number 21. Question number 21. We'll take a small break and then we'll take question number 21 and more questions.